Hi, my name is Jim Evans, President of Gannon Security Partners. Thank you for taking some time out of your day to watch our video. Our videos are to help you understand the strategies you need to help protect you, your family, your business, and future generations. Those strategies will be all wrapped around retirement planning, estate planning, tax mitigation, and asset protection. I hope you enjoyed today's video. Please don't forget, subscribe to our YouTube channel, follow us on Twitter, like us on Facebook, and make sure you leave comments below so that we know exactly what you want to know. That's what we're here for. Thanks again, and enjoy today's video. Everyone, and welcome back to the show. My name is Jim Evans, President of Gannon Security Partners, and today's video is going to go over gifting strategies, why people do it, and what are the benefits. So we're going to jump right into it. We're going to take a look at a profile client here that I made up. Okay, so we have Joe and Mary. They're business owners. They're approximately ages 54 and 53. They own Construction ABC Company. They believe that it's worth around $2 million. They haven't got a formal valuation, but that's what they told us in our client meeting. They have two children, ages 24 and 26. They take a combined income of about $200,000 a year out of the business. They have rental income of $60,000 a year because they personally own the property that ABC sits on. Okay, so ABC Company pays them $5,000 a month to have that to pay for rent. Okay, they have approximately $500,000 in their 401k and profit sharing plan combined. They have an investment account which is non-qualified, meaning that they've already paid the taxes on those dollars. It's not pre-tax dollars, of roughly $500,000. They have a home that's worth around $750,000, and they take a K1 distribution of $150,000 a year combined. And like I said, ABC property, which is worth about $1 million, they own, so the business pays them $60,000 a year. Okay, they have a total assets of roughly around $5 million. They do not have a federal estate tax concern. Now, they're relatively young, so over time those assets could grow. Estate taxes could change. So those are scenarios that they have to be mindful of. But right now, it's safe to say that they don't have an estate tax issue. On the federal side, now depending on where they live, they may have a state estate tax or a state inheritance tax, depending on what the laws are in the state in which they reside. Okay, so their objective when they sat down with us was to reduce their estate tax if they have any, and also to maximize their legacy or maximize the amount of money that they can leave to the next generation, being their children. Okay, so there's a couple things that we do here, right, when we talk about gifting strategies to a trust. All right, the first thing is I want to list over here the benefits of doing the gifting. Okay, so what they decided they were going to do was they were going to gift ABC property. This is the property that their construction company sits on. Okay, so they're going to gift that, and that's roughly $1 million, and they're going to gift that into an irrevocable trust. Okay, once this property is now in here, the business, so ABC Construction Company, I don't know if you can see this, okay, the business is actually going to now send the rent check to them. Okay, so or send the rent check to the trust, because now the trust owns ABC property. Okay, they've given up control of it. They no longer get this rent check. The trust gets it. Now, if we imagine that the trust is on an income tax bracket of 40%, then they're going to pay roughly $24K a year in taxes. The trust is, which is going to leave them a net $36K. Again, these are rough numbers, so I don't know if you can see this. I brought the camera in a little bit closer today to make sure that you could see the numbers. Okay, so they have a net $36,000 a year. So every year, $36K is going to go into this trust after taxes. All right. Now, the question becomes, what do I do with the money once it's inside the trust? One of the options that a lot of people choose to use is use life insurance. And the reason for this is because it's a very safe asset, number one. Okay. Number two, let's say they each do $15,000 a year, okay, for husband and wife. So that's $30,000 total. They decide out of the 36, they're going to put $30,000 a year into the life insurance policy, okay? So they've already paid their taxes. They have a little bit left over for administrative costs, whether that's paying the accountant or whatnot. And then you also have to remember, too, that they're going to have to pay the property taxes as well. But they decided that because they have $150,000 in a K-1 distribution, they are going to use their annual exemption to gift to the trust so that the trust can pay the taxes. So that's taken care of already as well. Okay. So of the 36, they're going to use 30,000. Couple strategies they could use. They could buy a GUL, which is a guaranteed universal life contract, very little cash value inside the policy, but maximizes the death benefit. Okay. They could use a whole life policy, which I would recommend a 10-pay in their case, which means you pay it for 10 years and then the death benefit is permanently with you. The cash value builds up inside the policy beyond the 10 years, but you don't have to pay any more premiums after the 10 years of payments. Okay, so you pay it for 10 years and then you're done paying it, you're done contributing to the policy, and then the policy just continues to live on. The cash value continues to build, death benefit continues to build. You can have access to the cash. It's a nice way of doing it. Now, the other thing they could do is use, we'll call these permanent products. They could use a permanent product and a term product along with it. Obviously, if they use a term policy, let's say they went with a 10 or 15-year term policy, the amount of money that it's going to cost them to get maximum death benefit is going to be greatly increased with the term policy. This is one of the reasons why I think term policies are underused, because you can allow this term policy, if you have a whole life contract, the death benefit is going to slowly go up over time, okay? Using the dividends, depending on how you have the policy positioned and how you work it out with your agent. But the death benefit will go up over time. Well, what you can do is you can say, well, eventually my death benefit is going to be X amount, so I'm going to buy a term policy now, and then by the time the term policy lapses or it's no longer affordable, right, for that 10 years, now after that point, my death benefit on my whole life contract has increased so much that I haven't even lost anything. So it serves as like a window of time, a gap closer, if you will, regarding trying to get to a certain death benefit. So there's a couple different options here. Now, we have to go through the benefits of why people decide to do this. Well, one of them is they reduce their income by $60,000 a year, because they were taking $60,000 a year in rent from the business. They're no longer taking that. So they reduced their income by $60,000, okay? They also got a little bit of asset protection, which is what they didn't have before, because they no longer own the business or own the property, okay? They gifted that to the trust. So now if they would be sued, a lawyer can't say, oh, well, by the way, you also own ABC property, no longer is theirs, okay? They're also going to get, with the gifting, is they're going to get any future appreciation. Now, what I mean by that is over the long term, we expect, the client expects, that the value of ABC property is going to go up. Well, when they gave this gift, it was only a gift of $1 million, or approximately $1 million, right? Now, let's say fast forward 10 years, 20 years, this property may be worth $1.5 million, $2 million, $3 million. Well, all that future appreciation is outside of their estate. So when we were talking in the beginning of the video and we're saying right now they don't currently have an estate tax issue, well, they may in the future, depending on what estate tax laws are, okay, what the IRS code is at that time. Those do change, okay? And then the second part about that is well, obviously, if the property goes up, you're going to get closer and closer to having an estate tax issue or having an estate tax liability. So all that future appreciation is now outside of their estate. Using that money for the life insurance policy is going to maximize how much they're going to get to the next generation. This next thing it's also going to do is, as their assets, which we see over here, okay, we listed some of their assets, this might not be all of their assets, but as their assets go up, right, like their home, their investments, their 401k, as the business could even increase in value, they may have an estate tax issue, but this death benefit is not going to compound that. A lot of people forget about the fact that when you have a life insurance policy, in a lot of states, not all states, but a lot of states, that death benefit is going to be includable in your estate. So for instance, let's say I have a life insurance policy of $3 million, okay? And when I pass away, my estate had a total of $5 million. Well, I know that I don't have an estate tax issue because I am allowed in 2016 to have $5.45 million before the federal government says, hey, we have to tax you on your estate. Problem is when I actually die, I don't have a $5 million estate, I have an $8 million estate because the death benefit was paid to my estate because I personally own it. Now, there are some states that don't tax the death benefit on a death tax. It's never taxed on an income tax basis, which is what I think a lot of people get confused on. Is they say, oh, well, you know, isn't that tax-free? Yes, it's income tax-free. The death benefit on a life insurance policy is income tax-free, but it's not necessarily tax-free. So you have to know where you live. You have to know the laws. I keep on saying this because I don't know where you live, but I want to help you at least know what to ask or what information that you want to seek out. Okay, so benefits, you're reducing your income by $60,000. We get a level of asset protection that we didn't have. The future appreciation is outside of the estate. We're also getting the death benefit out of the estate. So that death benefit is going to be paid to the trust for the benefit of the children. And then the next thing is it's keeping it in the family. And the reason I bring that up is because a lot of people, when they're doing estate planning, who have saved money, they've built a nice list of assets, right? They've done the right things with their money to accumulate wealth, right? They want to leave that to their children, but they don't necessarily want to leave that to potentially a spouse that leaves their child, right? So like, let's say I have a daughter, she gets married to a guy, everything's great, I die, death benefit goes to her. Now the marriage is having problems. They get divorced, and now that spouse says, hey, listen, you have X amount of dollars over there. I want that too. I want half of that. So with this, because they're leaving it to a trust, an irrevocable trust, and that benefit, that trust is going to continue to live beyond their lives, or at the very least, it's going to, one of the beneficiaries is going to be another trust that's going to form after their death. That asset that sits in that trust is not owned by their child either. So again, you have another level of asset protection. You have another level of protection from that money going to people that you did not necessarily want to leave it to. So it's a strategy. It's very simple. There's obviously more complex ways of doing this, and advanced planning strategies that you can utilize when you're looking at this, but I wanted to just give a food for thought moment where you can take a look at what can you do with an asset and how can you use rental income coming off of that asset to perpetuate more money to the next generation. So I hope you enjoyed today's video. Don't forget, like us on Facebook, follow us on Twitter. Please subscribe to our YouTube channel. We've been getting more and more subscribers, and that's allowing us to help more people. Again, I keep on saying this. Actually, I got to tell this story. I had somebody call me yesterday, a client of mine, and he says to me, he goes, Jim, I love the videos, but aren't you giving away all your trade secrets? Aren't you giving away all the information that people could go use with another advisor? And I said, yes, absolutely. I'm giving away the strategies, and I'm doing that because I want the information to be out there, and I want people to have the information they need to make good decisions for their family. So if they choose to go with another advisor, there's nothing I can do about it, but I feel really, really good about the fact that my information is helping people. So with that, that's why I'm doing this. That's why we're here at Gannon Security Partners. I thank you for watching today's video. Please follow us on social media, and we'll see you next time. Have a great weekend, guys.